As long-term investors, owner-occupiers, or first-home buyers looking to purchase a property for the first time, I think it is very important for us to have a long-term outlook and be forward-thinking. What I'm seeing a lot right now is that a lot of people are simply focusing on the short term and this crazy boom cycle that we're currently experiencing and getting caught up in the emotions and the FOMO. In today's video, we are going to look beyond this short-term boom cycle and see what is likely to happen after this boom cycle, and talk about some factors that will have a dramatic effect on the housing market going forward, as well as the property cycle, which we can use to give us an indication of what's coming. Let's look past the media headlines and focus on the concrete data, so we can make better decisions going forward, because there will definitely be some opportunities and good ways to make money in the coming years. But the road ahead is not one without danger. As always, this is not financial advice and I am not a financial advisor. I will always encourage you to do your own research and due diligence and get help from real financial experts before making any big investments or financial decisions. Let's talk about the 18-year property cycle. If you haven't heard of this, this is a very popular and common theory used by a lot of property investors, and they use this to time their exit and entry into the market. I'm personally not too big on trying to time the market, but let's take a look at this theory because I think there are some very important takeaways that we can use to help us make better decisions. The cycle starts just like any other cycle, in the recovery phase after a major economic shock that crashes the property market, like the 2008 global financial crisis. As you already know, the Australian economy and the Australian housing market was very strong back in 2008, and as a result, the GFC had little to no effect on the housing market, and all the government stimulus actually sent our markets into a boom cycle right afterwards. So if you look at the graph of this property cycle, 2008 was the beginning of the 4-year recovery phase where prices trended downwards before hitting a bottom and then stagnating until the start of the recovery phase in 2012. This was also when the Australian housing market started seeing some confidence coming back into the market, and as a result we started seeing strong and consistent growth. If we look at the graph here showing the national median house and unit value, after a small correction in 2008, the property market went up and then down again before setting into a nice uptrend that started around 2012, which is actually quite freaky because it follows this 18-year property cycle quite accurately. Based on this property cycle theory, the recovery phase should last around 7 years, and during that time we will see a steady growth, which is once again exactly what we saw in Melbourne and Sydney. After the 7 years of the recovery phase, the model suggests that we will see a mid-cycle dip, which is once again exactly what we saw from 2017 to 2019 when APRA stepped in to introduce tougher lending criteria, which restricted the flow of credit and ultimately led to a correction in our biggest markets. Guys, this is honestly quite freaky, and this model has been extremely accurate so far. But it is very important to point out that this model has only been accurate for our biggest markets, Melbourne and Sydney. The median house price in Perth has been dropping for the last 2 decades, and is only just starting to see a recovery phase. And Hobart, on the other hand, has seen very strong growth for the last 7 years without any corrections or any dips. And the reason for this is because the Australian property market is not a singular market, but it is instead many sub-markets that are all following its own cycles. And later on in the video, we will discuss how we can use the property cycle to our advantage and use this information to identify markets that will outperform in the coming decades. Now, going back to the property cycle, after the mid-cycle dip from 2017 to 2019, we now move on to the most exciting phase of the cycle, the explosive phase that generates insane amount of growth. Let's now take a look at what this explosive phase consists of. 1. Huge building projects. Usually this means huge developments and apartment projects, but this is something that has been happening for decades now, with the government stamping off on crazy amounts of apartment buildings. However, if we look at this from another point of view, land development and construction is booming, with the government giving off very generous stimulus programs to encourage first-home buyers to buy new buildings, off-the-plan builds, as well as home and land packages. Enthusiastic media headlines. This is definitely very evident on all the news channels and every media outlet in Australia. This is also something property-obsessed Australians love to hear, encouraging them to go after the Australian dream. 3. Banks relaxing their lending standards. Look, I don't think this is something we need to spend too much time talking about because this is very evident with the scrapping of responsibility lending practices back in April, as well as the government encouraging first-home buyers to jump into the market with only a 5% deposit. And finally, prices rise. quickly. This is also very evidenced by the insane levels of price growth we have seen since the start of 2020, with the fastest rate of growth since 1988 recorded in March, meaning I have not witnessed a faster rate of growth in my entire lifetime. Based on everything we have seen in the property market over the last 13 years and everything that we are seeing right now, it seems like that our property market is following this 18-year property cycle to the T. Even though the accuracy of this property cycle has been extremely freaky, and matching real-life events to the actual phases of this cycle has been very interesting. The only reason we are doing this is to get an indication of what is likely to come. So let's go over the rest of this 18-year property cycle and match it to actual events that we are likely to see happen in the coming years, so we can get an indication of what's likely to happen. Based on this model, this explosive phase is meant to last for 7 years. And assuming our current property boom started back in 2020, when the first wave of government stimulus programs came out, this growth cycle should end somewhere in 2026. At our current rate of growth, I personally don't see our growth cycle lasting that long. However, the thing that is reassuring right now is that the rate of growth is actually slowing down. However, in my personal opinion, there are some factors that will have a very strong influence on the rest of this cycle and play a very vital role going forward. The first and most important factor is, of course, interest rates. Interest rates determine affordability and borrowing capacity. Without record low interest rates, any prospects of a long growth cycle becomes very unlikely. With the Australian government and the Reserve Bank of Australia indicating that interest rates are unlikely to rise until at least 2024, this gives us a bit more room for some strong solid growth. However, the consequence to the record low interest rates and the record amount of money printing by our central bank and the central banks around the world is of course inflation. Even though inflation is an issue here in Australia, with the price of goods and services rising while income and wages stay stagnant, the biggest threat of high inflation or hyperinflation lies in the US, where more than 30% of the money supply was printed in the last 12 months. The Australian economy doesn't always follow the US economy, but if there's a sudden hike in interest rates in the United States, it is likely that we'll see a sooner than expected rate rise here in Australia. And it seems like that our Australian banks are already preparing for a sooner than expected rate hike from the Reserve Bank of Australia, with the Commonwealth Bank of Australia hiking its 3 and 4 year fixed rates for the second time since March. If the other banks were to follow suit, it could indicate that they foresee a higher interest environment in the near future, which is very bad for the housing market and our fragile economy. I have been telling my viewers on this channel for a very long time now, if you're worried about interest rate rises and higher repayments, now could be a good time to look into 3, 4 or even 5 year fixed rates to get some certainty going forward. It is very important to understand that higher interest rates does not mean the end of a growth cycle, because there are many other factors that have a very strong influence on affordability. For example, if interest rates were to rise, but wages and income rise alongside with it, affordability of a borrower would not decrease because they now have more money from the incomes to service that debt. And I personally believe if we want to see a long and sustained growth cycle, we will need to see wage and income growth. The second factor that will have a very strong influence on the housing market is of course population growth in the form of migration. Our governments originally planned to have our borders open by the end of this year. However, after some setbacks with the vaccine rollout and the crazy outbreaks we saw in countries like India, our government has now indicated that our borders will remain shut until at least mid-2022. Now, we all know that Australia is a very large country, but with a very small population. We are currently ranked only 55th in the world, right behind North Korea, with our population of 25 million people. And to become a leading economy, Australia will need more people, and you will need a larger population. And our governments have set in very aggressive policies to encourage people to migrate to Australia. With everything that has happened since 2020, our population has been shrinking. And I firmly believe that when our borders finally open in 2022 or 2023, our governments will have very strong policies in place to encourage people to migrate to Australia, to make up for the lack of population growth that we have seen in the last 2 years. According to the data released by the Australian Bureau of Statistics, in the 12 months leading to June 30th, 2020, Australia's population increased by 194,400 people due to net overseas migration. This is a very big number, and without this number would have been much higher. Imagine if the government introduced more favorable immigration policies that attracted more people to migrate to Australia, and we could see anything from 250,000 people to 500,000 people migrating to Australia every single year. And all of these people will need somewhere to live. And this is going to be extremely favorable for our housing markets and our economy. It will put even more upward pressure on prices. And combined with the generous government schemes to support the first home buyers and the construction industry, I believe we're going to see very strong price growth when our borders finally open. The third and final factor that will have a very strong influence on the property markets will be government intervention and government policies that will either be favorable or unfavorable. If you want to see examples of unfavorable government policies, we can look at the government's decision to bring APRA to regulate the banks back in 2017, or the New Zealand government's decision to introduce tough policies to cool the housing market. Going forward, things like higher land taxes, like the one the Victorian state government has just introduced, and tax reform proposed by the New South Wales state government, all of these government policies will have an effect on the housing market going forward. It will either cool or boost the housing market. So I think it is very important to keep a close eye on the government's stance on the property market in the coming years. In my personal opinion, I believe the government's approach towards real estate will be mostly favorable in the coming years because of the $8.1 trillion tied up in Australian real estate, as well as the importance of the construction and finance industry, which is directly tied to the property market, as well as the direct link between the housing market and the Australian economy. When one sinks, the other one usually follows. Going back to the 18-year property cycle, as well as the factors that we have just discussed, I personally think that there is a strong chance that our current property boom could last all the way until 2026. This is provided that we see very strong population growth from migration in the coming years, and that interest rates remain low. And we also need to see growth in our income and wages as our economy starts to recover. There are a lot of variables at play here, and we need to monitor all of these very closely. A small change in any of these supporting factors could lead to a shorter than expected growth phase. We also need to understand that it is almost impossible to time the market perfectly. And even though this model has been very accurate so far, there are a lot of uncertainties in our property market, in our economy, and in the global economy. That's why I'm personally only using this model as a compass to point me in the right direction and to give me some idea of what's likely to come, but not relying on this like a roadmap. Whenever we're looking to borrow hundreds of thousands of dollars to purchase a property, we should practice extreme caution, and we should never overstretch ourselves financially because of FOMO. Because property investing is not a straightforward journey, and we need to give ourselves some wiggle room in case the unexpected happens, and we need to make sure that we have the ability to service these mortgages and hold on to these properties in the long term so that we can ride out any small bumps on the way. Earlier in the video, I did mention that this model has only been accurate for Melbourne and Sydney, and that there are many other markets in Australia all following their own little cycles, and we can use this information to our advantage and identify markets that will outperform in the coming decades. But this has been a very long video already, so I'll make another video going over all of that in much more detail, as well as my game plan for the next few years to maximize my returns in the property market. So make sure you subscribe to the channel and turn on the notification bell so you're notified when that video is released. I want to thank you guys for watching this video to the very end, and I want some feedback from you guys. What do you think about the 18-year property cycle? Let me know in the comment section below. If you enjoyed the video, please do me a huge favor by hitting that like button right there. It will really help out the channel. And I'll see all of you guys in the next video.